Let's bring in former Barclays CEO Bob Diamond, now founding partner and CEO of Atlas Merchant Capital, joins us right here at Post 9. Yeah, Jamie, I mean, we're only 140 basis points from 6% on the 10-year. I don't know if you think we're going that high, but we hit 4.6 again this morning. Does seem to have had an impact. What's behind your sort of lack of belief that we're going to see significant cuts?
David, when we came into this year, if you look at the second half of 2023, then all of us saw an economy that was somewhat stronger than we expected. We saw inflation somewhat lower than we expected. And we saw continued real strength in the job market, in the labor market. And so coming into this year, it just didn't seem logical at all that the Fed would take the risk of cutting rates and therefore stoking inflation when the economy was strong. So I think the Fed is going to only cut in the second half of the year if they see some combination of economic weakness or inflation coming down. And you know, if we look at the first half of this year so far, the economy's been what? A little bit lower than we thought in terms of growth. Inflation a little bit higher than we expected. And for the first time, we're seeing a little bit of dislocation, a little bit, in the labor market. So, you know, I don't think there's going to be a rate increase for sure. I think there could be one small cut this half, but I think it's very, very dependent on what the Fed sees with the economic numbers and the inflation numbers as they come out in the second half.
What do you think when you hear somebody like Jamie Dimon warn an audience of people who are probably younger than we are about, hey, you've never seen 6% on a 10-year, but believe me, it can happen. Do you think it could happen? Is it a real possibility?
I mean, you're aging me, man.
Well, you're not alone.
I started trading when Volcker was chairman of the Fed, and you know I remember the 13 7/8 of I think it was the 13s of 11, the 15 7/8 of 20. I mean, we had rates that were very, very high, and we had inflation going out of control.
Yeah.
And I think you hit the real nub of it, David, which is if you are the FOMC, whether you're the chairman or member of the FOMC, and you're not seeing economic weakness, then cutting rates has a risk of stoking inflation. And if they cut rates before the economy weakens or when the economy is still strong, they run a risk of having to reverse course. And I think whether it's for what's right for the economy or what's right for their legacy, they're not going to take that risk.
So your view is it's bad to be early. The Fed can never really be early. They have to be late.
Well, I mean, if you put it in context, Carl, the biggest mistake they made in a period when they've really played a blinder in many, many ways, if the world looks at the U.S., is they waited too long to raise rates. And I think getting themselves in that position, I think they're going to be cautious. So they're going to want to see some economic weakness before they cut rates.
There's also
I mean, 25 basis points doesn't matter in the scheme of things. So, you know, maybe there's a 25 there for signaling reasons, but I don't see I don't see the Fed, the FOMC, taking the risk of stoking inflation right here.